What's up, you guys? Welcome back to the channel. Today's video is going to be about an option strategy which I think a lot of you guys can actually benefit from. And this is the LEAPS trading strategy, which stands for long-term equity anticipation securities. So as the example stock, I have AMD pulled up here, and you guys want to choose a stock that you think is going to be on a general upwards trend over the next year to year and a half or so. And while this strategy does work for most stocks if they are on an upwards trend, generally people are going to benefit more from growth stocks and stocks that see very drastic changes in their share price, especially when they're on an upwards trend. And so I think AMD is a good example to show you guys on. And because AMD is in the tech sector, and this sector has really been increasing over the past few years, and there's likely a lot more growth in the future, that's probably going to cause AMD to increase. And that's where this LEAPS option strategy would come in, and it'd be very beneficial to people that have a bullish mindset on a stock like AMD. Now, in order to open a LEAPS option, first you have to have options enabled in your trading account, whether that's Robinhood or any other trading brokerage that you guys use. So first you need options enabled. Then we head over to the options chain, and we're going to be buying a call option that expires at least 6 months in the future. And ideally they're a year or more, and that way you're getting tax benefits and you're not being taxed at short-term gains. Rather, it's long-term gains if you hold past 1 year. Now, it's not the end of the world if you buy one that's less than 1 year. That's just going to be a taxable event, and you're going to have to pay a higher tax rate than if you held for longer than 1 year. So we're going to go up to the expiration dates and choose one that's far out into the future, and ideally past 1 year. So now scrolling to the bottom of these expiration dates, unless we wanted to extend this out to January 20th of 2023, the next soonest is actually June 17th of 2022. So it's not quite 1 year, so we wouldn't get the long-term capital gains as if we had held for 1 year. But I think this is going to be fine to give you guys an example and show you exactly how these work. So now we have the June 17th, 2022 options chain selected. And the first thing that we're looking for is we want to find a delta that's at least 0.6 and ideally 0.7 or higher. And the way to find this is to go deep in the money, and you're going to click on the option and you're going to be able to see the delta, the theta, and all the Greeks. And that's how we're going to find one that's 0.7 or higher. So if we scroll down here, usually it's quite a few down in the money before you're going to get to that 0.7 or higher. And so if we try with this $80 strike price, you can see here the delta is 0.69, so that's right around where we want. Maybe we'll go a little bit lower just to get 0.7 or higher. And now at this $75 strike price, we have a delta of 0.74, which is right around that area, ideally between 0.7 and 0.8 where you want to be. Now, a lot of you guys are probably wondering what the actual benefit is to owning a LEAPS option. And the entire goal of buying a LEAPS is that you're trying to control as close to 100 shares as possible at a reduced price. So you're using leverage to your advantage, and you're greatly reducing the upfront cost, but you're still controlling nearly 100 shares of the underlying stock that you're trying to buy. So just to kind of clarify a couple things, the reason why we were looking for a delta of 0.7 or higher is because this is how many shares we're simulating owning by buying this call option. I'm sure most of you guys are aware that when you buy an option, everything is times 100. So the price that you see here of $23.10, that would be times 100. So you'd be paying $2,310 to open this call option. But in return, you're basically controlling 74 shares of AMD. And that's what the delta stands for. It's how many shares you're going to control by buying this call option, and it's also how much money you're going to make with a $1 increase or decrease in the share price. So if AMD goes up by $1, this $2,310 is going to be worth $2,384. Now vice versa, if AMD drops by $1, that $2,310 is going to be worth $74 less. And this $23.10 is made up of both extrinsic and intrinsic value. And if we start off with intrinsic value, that's the value given to the option based on the strike price and based on the current share price. So if you take the current share price of $90.66 and you subtract the strike price of $75, that leaves us with an intrinsic value of $15.66. And this is the value given to the option if you were to exercise right now. That's the difference between the strike price and the current share price. Now, whatever is left over, that's what we call extrinsic value. And to figure this out, you take the price that you paid for the option, which is $23.10, and you subtract $15.66, which was our intrinsic value, and you're left with $7.44. Now this $7.44, this is truly what you're risking by opening this call option and by opening this LEAPS. If AMD were to trade totally flat and they expired at a share price of $90.66, you would still be able to exercise this option and you'd be able to buy the shares at $75 and then you could sell them for $90.66. So you would still have that $15.66 worth of intrinsic value because that's baked into the price of all options. But you would end up losing the $7.44, which is times 100, so you would lose $744. So this $744 is what you're willing to risk and potentially lose versus owning 100 shares of the underlying stock, which in this case is AMD. But if you were to own 100 shares at $90.66, you would need $9,066. So the advantage of the LEAPS option is that by paying $2,310 for this call option, you're given the ability to control almost 75 shares based on the delta of 0.7462. And in return, you're paying a fraction of what it would actually cost versus buying 100 shares, or in this case, 75 shares of AMD at $90. The difference between buying 100 shares at $90 and buying $75 with this call option, you're left with $6,756, which is freed up capital, which you can use to invest elsewhere, and what you can use to make back that extrinsic value, the $744 that I mentioned earlier. And in case you're wondering, that $744 ends up being about an 11% return on the $6,756 difference between this call option and owning 100 shares. And 11% really isn't far off from the average market return over a 20-year period. Typically it's around 7 to 8%, so you would need slightly above a market average, which really wouldn't be that hard investing in some kind of tech sector or certain tech stocks that really have a lot of growth potential. So you can see this is really the benefit to buying LEAPS options. You're able to control a large portion of shares, upwards of 100 shares, with a great reduction in the price that it would cost to flat out buy 100 shares. And another reason why this makes it such a great trading strategy is because your gains are pretty much infinite as long as the share price continues going up. In this example, every dollar that AMD goes up, you're making almost $75. And also, as the share price continues going up and pushing this option deeper in the money, that delta is going to increase more and more the deeper it gets. So if the share price were to go up another $10, maybe this delta would be at 0.85, and so you'd be making $85 for every dollar that the share price goes up. Now there's also another huge advantage to buying LEAPS options over just buying shares alone, and this is that your losses are actually capped. Say for example, you bought 100 shares of AMD at $90 and then AMD drops all the way down to zero. Now, of course, this is very unrealistic, but we're just going to use that as an example. Well, if you were holding 100 shares at $90 for your average share cost, as AMD drops down, you're losing money constantly as it drops down, and your 9,000 would go all the way down to zero if AMD went bankrupt and went all the way down to zero. Now, there's a huge difference with a LEAPS option because as AMD drops, and if they get all the way down to $75 and then they continue dropping down past, and say they do continue going all the way down to $0, well, your losses are capped at $2,310 because that's what you paid for this option. The option can never lose more value than it's worth, specifically talking about LEAPS options. And this is also referring to at expiration. Prior to expiration, you're still going to have some extrinsic value left over because that's taking into consideration volatility and theta, which are two of the things that makes up extrinsic value. So anytime prior to expiration, you're probably going to have some extrinsic value left over, but that's one of the things that makes LEAPS options so beneficial because your gains are pretty much infinite. You have a leveraged position, and you also have downside protection at expiration if the share price drops below your strike price. And if you compare that to owning actual shares, you're losing money all the way down until the share price hits zero. But again, you're capped at that strike price, and your losses are capped at what you paid for this option. Now, I know a lot of people are going to wonder, well, what happens if your option goes really deep in the money and say AMD shoots up to $150? Well, now this $75 strike price is way in the money and there might not be enough liquidity for you to get out of the position. Well, if that actually happens, you're going to have a lot of gains from AMD shooting up so high that you probably shouldn't be worried about the liquidity, because if this gets all the way to expiration, all you have to do is exercise this call and you're going to be giving up extrinsic value. And so you would be out about $700, but you would also be up way higher than that because AMD shot up so high. So as I mentioned, if AMD were to go up to $150, that's going to be a $60 increase in their share price. And if we times that by $75, which is about the delta, because remember, that's how much this option is going to increase with a $1 increase in the share price. So $60 times 75 comes out to $4,500. And this isn't even quite what it would be. It would actually be a little bit higher than that because again, the delta is going to increase the deeper in the money this option gets. So you're looking at over a $5,000 gain with a potential loss of $700 because you couldn't get out of the position. And that's figuring that the liquidity gets so low because this option gets really deep in the money. Typically that doesn't happen unless the share price really shoots up high. And if that is the case, I think that's a good problem to have. I would much rather have the share price shoot up high and I have to exercise my option than having a lot smaller gains because the share price only went up a few dollars. But just keep in mind, if that's what it comes down to and you end up having to exercise your option, make sure you have enough available cash or buying power in your account to actually be able to purchase 100 shares at your strike price. But again, that's only if the liquidity dries up and you're not able to get out of your position before it expires. Now, one last thing I wanted to mention is that at any point you can sell out of this position, and as long as you sell it for a higher price than you bought in for, you're going to be making a profit. So again, if you bought into this position for $23.10 or $2,310 and say the share price of AMD went up by $5, well, again, we take our delta of about 0.75 and we times that by 5, which is a $5 increase in the share price, and we end up with $375. So that $2,310 would now be worth $2,685, and we can sell out of that position for a gain of $375. Now you can also do the opposite, and if AMD is actually dropping and you want to get out of the position because you think it's going to continue dropping, you can sell out for a loss just to get out of the position, again, only if you think it's going to continue dropping. Ideally, when we buy LEAPS options, we're planning to hold them for months and months into the future. Usually you don't want to get out of your position unless you see a drastic movement in the price. And a good example of that would be if AMD shot up like 30% in a single month. Maybe you think they're going to pull back and drop back down to where they were trading after spiking up so high. So maybe you secure some profits and sell out of your LEAPS while you're ahead. And then when AMD pulls back down and comes back to where they were trading, then you can buy in and you just secured a profit by however much they increased in their share price times your delta. So I think this should give you guys a good rundown of how LEAPS options work, and personally why I think they're a lot more beneficial even compared to buying 100 shares of a stock. Now sure, buying 100 shares, you just kind of buy them and forget them, and you can hold them for years and years, where LEAPS are usually capped at a couple of years, because that's generally how far the options chain goes out. But if you like to be more of a hands-on trader and check in on your portfolio every so often, I think LEAPS options would be something to consider, especially if you already have a little bit of experience in options trading. They're not something that's going to make you rich overnight, but the possibility to make a lot more money over a longer period of time is definitely possible, and there's a lot of people who take advantage of this and make a lot more money as compared to buying just shares. Now, if you guys have any questions about trading LEAPS options, let me know down in the comments and I'll try to answer as many questions as I can. And if you guys are confused, just let me know down in the comments and maybe I can make a follow-up video answering any questions you guys have about this options trading strategy. Also, if you guys haven't signed up for Webull, make sure you guys sign up using the link in the description. And when you sign up and deposit $100, you'll actually get 2 free stocks. Also, if you guys enjoyed the video, make sure you leave a like because it really does help out the channel. And with that said, thank you guys so much for watching and I'll see you back here in the next one. Bye.